Hello, this is Gary Corla with Sovereign Wealth Management, and it's time for our 2024 market update. Before we get into the markets, we'll talk about some new changes as it relates to personal finance, such as rules for contributions and taxes. And then we'll proceed on to the markets and how we're investing in light of the current market conditions. So let's proceed. None of this should be considered as investment advice, given it is general in nature and is not tailored to any specific investor. Regarding personal finance, Medicare, the standard monthly Part B premium is rising by $10, and for most people it will be $174.70. If you are in the higher income tax brackets, then your premiums will be even higher, but for most people, this is the number. For Social Security, there is a cost of living adjustment or a 3.2% increase in the Social Security benefit for 2024 due to inflation. For standard tax deductions for single filers, there's a $750 increase to $14,600 and a $1,500 increase for couples. And you have here the table comparing the changes and the tax deductions, the standard tax deductions for both single filers and for joint. Tax brackets have shifted higher by over 5% to adjust for inflation. And estates of decedents who pass away in 2024 have a basic exclusion of $13,610 at this point. Now that is expected to drop to $7 million in 2026, which is quite a big deal if the laws don't change before then. Retirement account contributions, 401k, 403b, TSPs, the employee contribution limit is $23,000 with a $7,500 catch-up if you're over 50. And for IRAs, the contribution limit is $7,000 with a $1,000 catch-up. Starting 2024, you're able to withdraw $1,000 per year for emergencies without a penalty. The funds do have to be repaid within 3 years, and no other yearly free withdrawals or penalty-free withdrawals can be taken until the $1,000 distribution from the previous years has been repaid. College savings and how it relates to Roths. This is an interesting new rule change where if there is a student who did not use up all of their 529 contributions or savings, then you can now, if you're as the owner of the account, can roll those funds up to $35,000 into a Roth IRA for that same beneficiary to give them a nice head start into planning for retirement. That 529 account must have already existed for 15 years for you to be able to make this conversion. Student debt and employee 401k matching. Employers can now start matching employee student loan payments with contributions to their workplace retirement plan. So, in other words, if you have somebody who is paying back their student loans, those can count as contributions so that the employer can make a match for the same amount into the plan, depending on the plan rules. Gift exclusion and superfunding 529s. So what is superfunding? It means that in any 1 year, someone can make a 5 years worth of annual gift exclusions into a 529 plan. So for 2024, someone can gift $18,000 per person without having to file a special form. So the gift exclusion is $18,000. And for 529s, again, you can multiply that by 5, so that would be $90,000. And that certainly gives a nice head start to saving for college for any student. So this makes sense for large estates. Again, the exclusion for estates is expected to drop from 13.61 million in 2024 to 7 million in 2026. So this may be something to think about. It adds up over time. Now let's talk about the markets. What do we see and where do we think things are going? Where are we in the macro cycle? Currently, based on the base case, most of the data, we're actually in macro spring, otherwise known as a disinflationary boom, where we have rising growth and falling inflation. And this is considered early cycle before the summer, where we should have further growth if the data is correct. Now, where are we seeing this positive data and what is it being based on? So liquidity, or how much money is flowing through the markets, has a great, perhaps the greatest effect on market prices. And if you look, when we have high liquidity, which is marked by the orange line being close to the ceiling of this chart, that's when you have the markets doing really well. If you look at the bottom of the chart, which is low liquidity, that's when you get the banking crises. And at the same time, of course, around those banking crises, you see a big turn as the central banks turn on the spigot and let the liquidity flow. And as you can see where we are now, the liquidity has greatly started increasing since we had the, you could say, mini banking crisis early in 2023, with a few smaller banks failing and a few other issues around crypto. So that's starting to help improve market conditions. So you could say the Fed is adding liquidity to the market to keep the crises from happening. That's part of it. But there are also other, some very important data points which need to be considered as well. So the black line is the forecast supply of new government debt issued by the United States in billions. You see, so that's how much government debt needs to be issued by the US government to fund its spending. So you see we're here now, and you see the line going straight up. Now, the Fed liquidity injection is projected to also slightly increase over time. Now, the money to buy all this debt has to come from somewhere. So it is actually likely that this line of liquidity will go up even further. But even in this projection, you see that there is a positive tilt, meaning the tightening doesn't seem to be as credible as it was before. And therefore, more liquidity, then you have higher market prices. Just to show you how closely liquidity relates to market prices, this is the black line is the global stock market index, and the orange line is global liquidity. As you can see, that correlation is close to 100%. U.S. Fed liquidity and the balance sheet from 2018 to 2023. So what do you see here? The balance sheet is the dark red line. And when the Fed started tightening, they threatened to tighten around 2022. That's when the market started going down. So you see they tightened. Then we had that crisis, the mini banking crisis we already discussed around February, March. Then the Fed increased the balance sheet quickly, but then it has continued to wind down the balance sheet. However, they've found ways to sneak liquidity into the markets while at the same time tightening the balance sheet. So the overall Fed liquidity has actually been increasing. And you can see the decrease stopped around the United Kingdom gilt crisis. So when last fall, or 2022, September of 2022, there were some issues with pension funds and the gilt market with interest rates spiking very quickly, and that really made the central banks nervous. And since then, they've really backed off of a real net liquidity drain from the markets. And so you can see these two dotted lines are what the projected quantitative tightening program is supposed to have been. And you see, even by the official balance sheet number, they're lagging in the tightening. But if you count this Fed liquidity line, the actual net liquidity overall, not just the balance sheet, you can see that liquidity is actually rising. So that's been helping the markets stay elevated. Another chart around the same type of mindset. So the current Fed balance sheet, the white line, as you can see, it's similar to the dark red line in the previous chart. And then you have current expenditures and interest payments with a 36-month lead. And as you can see, Fed balance sheet very closely follows federal government expenditures, interest payments. You see, so again, when the government spends more than it takes in, that money has to be found somewhere. And most likely the easiest place for it to be found is the Fed buying up a lot of that debt, or finding ways to inject liquidity to finance this debt. U.S. Fed liquidity and the NASDAQ, or U.S. tech stocks, basically. So you have the NASDAQ as the orange line, and then you have Fed liquidity as the red line. As you can see, very close correlation. So the reason I keep talking about this is it seems to give us some good guidance around where the markets are going. And as you can see, we're seeing an upward line here. So an upward turn in liquidity, as well as the NASDAQ over the last few months. Overall, if you look back to 1970, and this is another great chart from Cross-Border Capital, one of the premier research services that I like to use in our decision making. So the liquidity cycle is actually quite predictable. So as you can see, it's been great in terms of helping time market volatility. So you're seeing now that cycle seems to continue every 3 to 5 years. There's a downturn in liquidity, then there's an upward swing. And it has a lot to do with the refinancing cycle. Around every 4 years or so, especially after the great financial crisis, what started being noticed is the global economy, the productivity does not grow enough for all the new debt to be refinanced. So rates have gone to zero, and the Fed increases the size of the balance sheet to find money to make all those interest payments and refinance all the debt. So the rates basically have to keep getting reset to zero, so all the corporations and the government can refinance its debt periodically. So here we have the ISM. So that's a survey from the Institute of Supply Management. And then you have the GMI Financial Conditions Index. Now that financial conditions index has been great lead into what happens to the economy and therefore the markets. So you see it's leading the ISM, which is another very important indicator of economic health. And as you see, there was a big downturn from mid-2021. The economy went down, as did the markets, but now we're seeing an upward momentum in the financial conditions index. And the GMI, by the way, is another great research service that we often use in our decision-making process. It's a global macro insiders. So if we look at this chart, you see that the financial conditions index is improving, and it's likely that the ISM, a very important data point, is going to improve also, which signals better market conditions. Investors' exposure to risk assets. So as you can see, there was a low in March, then the investors continued to take on risk, but now we're back to a relative low, which means that there's plenty of dry powder to increase risk assets in portfolios. Here's an interesting chart in terms of S&P 500, so the US stock market, how it behaves. So this left side of the chart, the white line, is the stock market in 2023. The green line is how the stock market has behaved on average every single year since 1964. So you see the market has tracked this pretty closely this year. So seasonality still works. This next chart on the right, this is how the market behaves in presidential election years. Of course, every single incumbent wants to get reelected, so there's always a lot of games being played with stimulus and easing of financial conditions every way that it can possibly be done, and therefore you have in general a very strong market in election years. So that's another indicator which might help us make money in risk assets next year. In terms of commodities, to which we do have exposure in our portfolios, this middle green line is just the regression. As far as this chart, that's the commodity index since the mid-90s and how it's behaved in the market, and the green shaded area is 2 standard deviations from the mean, or the middle of this price chart. Now, as you can see, when we get over 2 standard deviations, that's a good time to sell because we're likely going to have a bear market in commodities. And when we get down to the bottom of the channel, that's a good time to buy because we're likely to be starting at the beginning of a secular long-term bull market in commodities. So what we're seeing here is we're right in the middle of the range. COVID was the absolute low, and we're likely to have more gains overall over the next few years in commodities. That's why we've increased exposure there. Wheat is one of the commodities we're invested in, and as you can see, smart money, this blue chart, these blue bars are smart money, meaning professional investors and traders buying up wheat. We're seeing some good movement in the wheat's markets. This is the overall price chart of wheat, and that's just one of the agricultural commodities that we're interested in right now. Let's talk about investment strategy in our portfolios. How are we investing? The sovereign managed growth strategy is our main strategy, where we deploy stocks and some commodity exposure in client portfolios. So currently, we are fully invested in risk assets, meaning in mostly stocks and some commodities. We had some short-term bonds as we were waiting for conditions to improve. We've sold those off. Now we own, if we just break it down by sector, 17 or 18% in technology, 15% in energy, 11% financial services, and consumer defensive, and a few other positions as well. As far as market cap of the different types of companies we're invested in, we're actually overweight mid caps, which likely do well in improving markets, and about 40% large cap as well. Regional exposure, we're close to almost entirely being in the United States, so about 78%. Some exposure to Canada, as well as developed and emerging markets. So let's talk about the different themes we're invested in, and for clients, they're aware of most or all of these, but we've certainly made some pretty substantial changes recently to the portfolios and added to some of these themes. So we're looking at investing in what we think will be the outperforming areas of the market over the next decade or so. So that's real assets and commodities. They can be used interchangeably often. Then we have inflation, onshoring or reshoring, friendshoring, given what's happened with COVID and with some of the geopolitical issues. Everybody wants to, all the different superpowers, so to speak, and influential countries want to have dependable supply chains. Digitization, crypto, and tech. We have emerging markets, particularly India. New energy, electrification, uranium. At the same time, traditional energy. Deep discount shopping, and publicly traded venture companies. So very small companies who have a lot of promise. They're very aggressive in risky investments, but that's why you hold very small positions, so that they don't greatly affect your portfolio if there's an issue. So as far as our themes, many of them overlap. Many of these investments are part of several themes which we think will be outperformers, and that's why it's great to have such investments, because if you're wrong on one theme, then the fact that you hold an investment where you may be correct on several of the other themes may be very helpful in terms of still producing performance, which is great, meaning you don't have to be 100% right to make good returns. So some of the themes that we're looking at, of course, we have real assets, new energy, electrification, uranium, traditional energy, and inflation. Now, Sprott Physical Gold Trust, that's actual physical gold held in vaults, which is part of the real assets theme, as well as inflation. Gold does well during inflation. A-Mark Precious Metals, also a gold-related investment. Gladstone Land, that's farmland in the United States, and that is definitely a real asset. Sprott Uranium Trust, as well as uranium mining. These two companies, of course, are related to real assets, because we're talking about mining a real asset, a real commodity, which is uranium. It also has to do with new energy and electrification, because if we're going to have a transition from old energy, hydrocarbon-based power, we need good base load energy source, which nuclear seems to be the predominant, by far the predominant, realistically speaking, source of non-hydrocarbon energy in the world at this point. And the United States needs its own supply, given the friction there is with Russia at this point, who has been the big supplier, together with Kazakhstan, over the last few years. We have Brazil Agro, which is also a farmland owner in Brazil. And we have Invesco Agriculture, as well as Tükrem Wheat. These two investments, of course, are, in terms of real assets, are very closely related. We have Oracle Resource Corporation, which is again mining for copper in Mexico. So this is a copper mine which has continuously produced good results in terms of their surveys, and we're just waiting for those for the markets to realize what we're looking at here in terms of potential buyout of this company. And so that's particular holding. Of course, that's an intersection of real assets because we're talking about actual copper in the ground. We're talking about electrification because you can't electrify without copper. And we're talking about inflation because it's a real asset. At the same time, we have the carbon allowance exchange traded note. This fund holds carbon allowances, or carbon credits otherwise known, from Western Europe, which is way ahead in terms of that type of regulation. So that's new energy type of investment. You could call it a real asset because it is a commodity, even though it's only exists in the legal space. It is a commodity at this point. There is a finite supply of it in the markets, and it's likely to go up as Europe really clamps down on carbon production by all of its companies. And then we have pipelines, U.S. energy pipelines, which is more of a traditional energy type of investment. At the same time, it is a real asset investment because these pipelines are actually tangible and they are related to commodities. And they do well in an inflationary environment. They simply adjust upward to adjust for inflation. Some other themes, again, onshoring and uranium. So we have here First Trust American Industrial Renaissance ETF. So this fund is going to hold companies which are going to greatly benefit as the U.S. transitions and rebuilds itself as a, again, hopefully a dominant industrial power in the world, back from over the last 40 years, or reversing the trend for over the last 40, 50 years where there was deindustrialization. Then we have Centrus Energy, which is an uranium enrichment company specializing in doing that which the U.S. has greatly lagged in because the U.S. has relied on Russia to produce enriched uranium for American nuclear power plants. So certainly Centrus would qualify as an industrial company. At the same time, it's done really well for us because we saw this trend coming in terms of electrification, new energy, carbon-free energy, at the same time doing so in the United States, given the geopolitical friction we're seeing at this point. Some other overlapping themes: digitization, crypto, and technology. So, to take advantage of the crypto trend, Grayscale Bitcoin Trust, there's likely to be, this is a closed-end fund, and there's likely to be an ETF which is produced, which is approved in the United States, so hopefully over the next few months, which should benefit this investment, which trades at a discount to the Bitcoin that it holds. When an ETF is created, that discount disappears because ETFs, exchange traded funds, do not trade at discounts. So we also have an investment, Skybridge Crypto Industry and Digital Economy ETF. This fund holds all the cutting-edge companies which take advantage of the trend in digital assets and crypto, as well as other high-tech industries. And then we have a more blue-chip type of a tech fund, which is the NASDAQ Technology Dividend ETF. This holds tech stocks, but tech stocks which pay dividends, so somewhere in between growth and value. We have the Simplify Volt Robocar Disruption and Tech ETF. This fund holds different types of AI, as well as robotic and electric car manufacturing and tech companies, which help us ride that trend. And then we have the Expanded Technology ETF, which is not, again, only concentrating on any specific sectors of tech, but is more broad and helps us take advantage of the broad, almost overlapping into some of the industrials as the U.S. reindustrializes over the next decade. And then several more themes if we're looking at emerging markets, India, as well as real assets. So The India Nifty 50 equal weight ETF, so it takes the biggest 50 Indian companies. Why do we like India? The demographics and the geopolitics. So demographics, India has an average age of 28 years old, which is just spectacular in terms of economic growth, because what produces good market returns? It's growth in the economy, in the GDP. What produces growth in the economy? Gains in productivity and gains in population. And India just recently became the most populous country in the world. And they have a good portion of their population which is very well educated, quite ambitious, and again, they're young, so they're able to help. Their demographics help where other countries are struggling with this in the West. And then we have Brazil Agro, which again owns farmland, so it's an emerging markets country, but they own a lot of farmland, which is a real asset, which will help us combine those two themes in one investment. And then perhaps the most interesting of the themes, at least in terms of how I feel about it, publicly traded venture investments. These are very small companies, often traded over the counter, so to speak. And they can be quite volatile, but they give us, you could say, a foot in the door in terms of potentially oversized gains or outsized gains in the future as these companies develop their technology. So ABAX Technologies was just granted license. It's a startup, but it's run by some very well-reputed people that granted a license to set up an exchange in Singapore to trade a lot of these new economy types of contracts, anything from natural gas to carbon credits and so on. And then we have Aduro Clean Technologies, which is nothing short of revolutionary in terms of how they have been able to improve on the processes of taking plastic, where currently there is only 15% or less of the plastic that is actually said to be recycled is actually recycled, to now taking 100% of the plastic and being able to recycle it using water and obviously very complex processes around water, while at the same time the same process with certain changes is also used to take bitumen, or you could say oil sands from, let's say, Canada, so unusable, very viscous type of hydrocarbon products, and refine them into something more usable. And Oracle, of course, again, is that copper mine in Mexico, which we're holding on to as an asset until it monetizes. Voxtra Analytics is revolutionizing and digitizing the real estate market. They bought up a bunch of different companies. They're integrating them into, you could say, one all-encompassing software, and again, a lot of promise there as well. Then we complement all of that with some core equity exposure. Simplify U.S. equity plus downside convexity ETF. So this is our core U.S. market exposure, but we're getting downside protection here. So if we go back to even a great book written by Mark Spitznagel, The Tao of Capital, where there's a strategy of buying portfolio insurance in a sense of when you hold the stock market, which is what Simplify U.S. Equity plus Downside Convexity ETF does, it holds the S&P 500, but they take 3% of that portfolio and they purchase put options. So in case of a big downturn in the market, you get protection in the portfolio and actually are able to monetize those options and buy more shares of the S&P 500 as the market goes down, as those put options pay off and increase in value to offset the losses. So when we have core exposure in the portfolio, and this is the biggest holding in the growth strategy, it allows us to reduce the risk of that market potential market crash by having these options in that fund. And I'm really impressed with Simplify and a lot of the strategies they're putting out, and they're taking advantage of some new rules changes which have allowed some of these strategies which were only allowed for hedge funds in the past. Now they're available in the markets for investors who could just hold them in their own account and they don't have to put $1 million into a single strategy. So we're taking advantage of this, trying to stay on the cutting edge for our clients here. And then we have another theme, deep discount shopping, pretty straightforward. Dollar Tree, grocery outlet. So as, unfortunately, inflation increases and times get tougher, the best of breed in terms of discount shopping, which Dollar Tree is in general, and then grocery outlet is you could say, is an Aldi alternative that's actually publicly traded, are able to ride that trend and hopefully outperform for our clients. Then let's talk about our bond strategy. Sovereign managed stability. What kind of investments are we taking advantage of here? How are we structuring the portfolios? So this is the allocation. We are deploying some quite interesting and exciting strategies, in my view. So if we look at the Simplify Enhanced Income ETF, this fund takes U.S. Treasuries, but they also, around that, besides collecting the yield on the Treasuries, are writing spreads, option spreads, which allows for an additional premium to come into the portfolio, enhancing the yield. Again, this is a hedge fund strategy, which is now available in an ETF form, and it allows us to limit risk, but at the same time get a great yield for our investors. First Trust Enhanced Short-Term Maturity ETF. This is a good way for us to get a nice, safe yield, healthy yield. Now that while short-term yields are high, we can get a nice yield of over 5% at times at a strategy like this without taking all that duration risk. Then we have the SIBO Vest US Equity Debuffer ETF. In a bull market in the stock market, when stocks are going up, a strategy like this actually makes sense for a bond portfolio. So what this is actually an investment in the stock market, but it's protected on the downside. After the first 5%, there's a 25% buffer, which protects the investor from losses for 25% of the downside. So in terms of volatility, it's quite close to how a bond may behave, much more stable in that sense, while giving us partial gains to the upside, close to around 12% if the market goes up. Simplify Short-Term Treasury Futures ETF and the Simplify Risk Parity Treasury ETF. So these two funds are invested to take advantage of short-term yields for the TUA. So using the futures markets to collect a yield, but at the same time use short-term Treasury futures to get exposure or to mimic the duration of longer-term bonds, such as intermediate term, so these 6 to 7 year bonds. And then the TYA, Simplify Risk Parity Treasury ETF, that fund uses intermediate term futures to mimic the long-term Treasury duration. So, for instance, if we think rates are going to go down, so longer-term rates in the medium term, that's a great way for us to collect yield, but also take advantage of those potential changes in yields, and such a bond fund would go up if long-term rates go down. Some core bond exposure with the First Trust Opportunistic Fixed Income Fund. It has done well over the last month as rates have decreased and bonds have gone up. Simplify MBS ETF. So mortgage-backed securities have not been interesting for a long time, but with rates going up so high recently, a lot of new mortgage-backed securities have come on the market. And of course, these have an implicit guarantee from the government, like treasuries. But often these mortgage-backed securities can yield as high as 6.5%. So what you're getting here is the risk, arguably, of credit risk of zero because of the backing of the U.S. government, while making a higher yield with these new mortgage-backed securities that have just come on the market in the last couple of years here with the higher rates. So that's what we have with this fund. And then we have the buffered gold strategy. So this fund again gives us 10% protection on the downside in terms of the potential losses in gold, but gives us a nice potential gain if gold goes up. So it gives us some diversification in our stability strategies, so our investors can collect a good yield overall from all of these funds, while at the same time give us some diversification in where the growth can come from. So in closing, thank you for listening today. We believe that there's some interesting developments in the markets for the next year. We certainly have to see what the administration pulls out of their pocket in terms of being able to get reelected, and how that's going to affect the markets. And we will continue to monitor the markets and all of our research partners and their research, and continue to look at how we can stay ahead of the trends, hopefully, and keep aiming to outperform in portfolios going forward. So if you have any questions, please give us a call or email us, and we'll be glad to address your concerns. Thank you. Have a good week.